All right, we're going to go ahead and get started. Good morning, everyone. This is Mahesh Odhrani. It's a pleasure to host the part two of our financial wellness series, all about cash flow and debt management. So, a couple of housekeeping items. This call is being recorded, and it will be available. The recording will be made available to everyone once it goes through a compliance approval process. The second housekeeping item, there's a handout available. The workbook is available in the handout section of the webinar. So if you did not receive the email or you did not download it yesterday, you can definitely download that as well. Just look for the handout section in the GoToWebinar app that should be on your computer. Thirdly, is there's a chat box and a question box as well. So go ahead, and if you have any questions, if you have any issues connecting, just go ahead and put it in the chat box or the question box. We'll go through the presentation, and then at the end of the presentation, I will answer any questions that have popped up in the question box as well. So with that said, let's go ahead and get started. Let me just minimize a few things over here on my end. All right. So for those that don't know me, my name is Mahesh Odhrani. I'm the president of Strategic Wealth Design, and I've been in the financial services business, for about over 17 years now. And what I've learned is over those 17 years that what truly shows success in individuals' lives when it comes to the finances is cash flow. The cash flow is their foundation of their personal finances. So it'll be critical, and this is one of the most important things that we discuss with our clients when they first come on board, is how do they manage the cash flow and what does that look like. So hope you all get great value out of this presentation, and let's begin. Oops. There we go. So cash flow and debt management are areas of personal finance that a lot of times individuals and families struggle with that we see in our practice. So we're going to discuss about how to build a financial foundation, and cash flow is a big part of that. And this includes many areas, which is defining your financial goals, identifying your threats that exist to your financial goals. How do you manage credit and debt? And then lastly is creating personal budget, and what are all the components for creating the personal budget. So the first topic that we're going to discuss today is all about building a financial foundation. So financial foundation is when a person or individual or family has that basic finances in order. This includes having a plan to pay off their debt, establishing short-term savings for emergencies, a plan for the future. And everyone's financial foundation is going to be a little different because it's all based upon their perspective. So how do you go about creating that? It's sort of a 5-step process that we always talk about, which is the first step is evaluating where you're at today. And then I use that analogy like going to the mall. So if I was to go to the mall today, let's say I want to visit a specific store, and it's a new mall that I've never been to before. Well, if I was to go to that mall, the first thing I'm going to try to find out is, hey, where's the map? Like, I need to know where I'm at today, and then look at where the store is that I want to visit, and then chart my best path to get to that store. So same thing with financial planning or building a financial foundation. It's evaluating where you're at today, and that's the first step. And the second step is defining that goal, just like we talked about going to the mall, is defining what my ultimate goal is, which store I want to go to in that example that I used. So defining that financial goal, where do I want to go? And then charting that course, developing a plan. That's the first 3 steps. What I call is the design phase. Is you're designing looking at where you're at today, defining your goals, crafting the strategy or the plan to get there. But where rubber meets the road is the top 2 items that we talk about is the implementation. That's where action is taken. So at the end of this presentation, you'll hear me say the biggest thing that you can do, it's a lot of great information that we'll go through today, but the number one thing that you can do is start taking action somewhere as we go through it. And there'll be a slide in your workbook, a page in your workbook where you can take some notes as to what actions you will take after this meeting. So when you're looking at evaluating, so let's talk about that first step, evaluating your finances. The first thing I would recommend, let's be completely honest and open with yourself. It may be uncomfortable for some of us, it may be overwhelming, but it is necessary to know where you're at today and what you're struggling with. So, for example, if you have a lot of debt that you struggle with, and so you need to know exactly how much you have. and you won't be able to measure your progress towards achieving some of those goals until you know where you're at today. And you get out what you put into it. So if you half-heartedly go about evaluating your finances, you'll only be cheating yourself. So the first step is always evaluating your finances is to be honest with yourself and look at where you're at today. And look at that vision. Like what's your you've heard Stephen Covey's begin with the end in mind. One of the habits of highly effective people. So begin with that end in mind. What is your vision? What are you looking at accomplishing? And those are the keys to your success. So next we're going to talk about your goals. So where are you now? Where do you want to be? And then what are your goals? What specifically are your financial goals? It could be paying off debt. It could be sending a child to college. It could be retiring by a certain age. So once you've evaluated your personal situation, next step is start building building the financial foundations by creating those goals that you want to accomplish. You can think of this process as like building a house. So if you were to build a house, you're not just going to start pouring concrete and nailing boards together without a plan. So same thing first. It's the prep work has to take place. The foundation has to take place. Has to be built. You have to envision what your goals are. What is the house going to look like? So at this moment, I'll take a pause for about a minute, and I will go ahead and open up that workbook. There's a section in your workbook where you can write down your goals. So go ahead and put down your goals. And again, that workbook is personal to you. So let's take a minute to put down what goals do you have in mind. All right. Let's go on to the next slide here, which is defining your goals. Many of you may have heard of the term, a goal setting term called SMART, the SMART technique. And the SMART is an acronym that stands for being specific, measurable, attainable, relevant, and timely. So a goal that's specific is the goal that's specific is one that's very clearly defined and described in detail as to what you want that to look like. So some of us may have written on the previous page, as an example would be, I want to save for my child's college education. Well, that's very generical. So let's see how we can make that more smart. So we're going to be more specific, which is I want to save for my kids' college education for the first 4 years of their college. Define the college, which college you want it to be, because college education and the cost of education can vary widely depending upon where they go, in state, out of state, and you have to define your goals to what you're willing to save for. And let's say it's a local university. I'm going to use UNLV as an example, proud graduate of UNLV. So, so defining that specific goal, I want to save for 4 years of college for my child to go to, let's say, UNLV. And by the time my child, my son or daughter, turns, let's say, 17 or 18. So being very specific. And also looking at, okay, how much time is left in that? So that could be maybe your child is 10 years old, and we know that you have about 7 or 8 years left. So that's a very, very specific, measurable goal that is clearly defined. A attainable goal is one that's that's realistic. So for example, if I say, hey, I want to have $1 million in the next 5 years. That's for a lot of individuals may not be attainable for many individuals. So, however, if I say, hey, I want to have $1 million saved up in 30 years, or by the time I turn age 60 or 65, and if I have enough time to that age, or if I have enough time, that's a much more attainable goal. So I always recommend make it attainable and have it be relevant to your specific situation as well. And then lastly, setting that time frame. What is that what is that time frame? Like bounding yourself to a commitment. So be it paying down debt. So I want to have all my debt, all my credit cards paid off by, as an example, would be by next year, by the end of 2021. That's again very specific, very attainable, and and time bound as well. So that's critical. So you're not just setting a goal that someday you'll accomplish this. So write down and prioritizing the goals is an essential. Writing down and prioritizing those goals is an essential step towards putting a financial plan into action. So once you have the, there's one second, there we go. So once you have the goals defined, the next step is to prioritize them. And a logical way to prioritize them is by a time horizon. So short-term goal, maybe for example, credit cards, having that paid up. A intermediate goal, maybe 5 to 10 years, is saving for a child's education. A long-term goal will be something like saving for retirement. So take a minute. We're going to pause you for a second, for another minute, and the goals that you wrote down previously, go ahead and start prioritizing them, and write down in terms of, I would say short term is generally about 1 to 2 years. Intermediate is between 3 to about 10 years, and anything more than 10 years is more of those long-term goals. So we'll pause for a minute and go ahead and write down, go ahead and prioritize your goals that you've written down on the previous page. All right. So now that you have created your priorities, we've defined your goals, it's time to establish an action plan. So an action plan will help you guide you towards your goals. And it's important as you're designing these goals is to create sort of what I call these milestones or these checkpoints. So if saving for a child's education is important, and that's one of your goals, maybe have a checkpoint at a midpoint to see if you're on track to accomplish those goals. If it's getting out of debt and paying off credit card debt, let's say within the next 12 months or by the end of 2021, is to have certain checkpoints so to know that you are making progress. Again, this is there's, I don't remember this exact saying, but it goes along something like you get what you pay attention to. So if you're paying attention to accomplishing your goals on a regular basis and having those checkpoints, it would help you accomplish those goals because you're focused on that. So, and that's what we talk about is developing awareness. One thing I always talk about, we've talked about before as well, is knowing where you're at today. It's accepting your current situation. So is to accept where you're at and then knowing what your priorities are and how you're going to accomplish those goals. So there are going to be what I call these non-priority items that are going to pop up in our lives. But if you have clear written goals, it's always easy to go back during those checkpoints and say, hey, I've got this non-priority item that had popped up. How does that compare to my goals? Does that impact my goal positively or negatively? So asking yourself those questions becomes important because, again, the more you're aware of it and the more focused you're on the goals, you'll be able to accomplish that. And we'll talk a little bit about the emotions, how emotions, a little too fast. We're going to talk about emotions, how emotions impact our decisions. So we are human beings. We are emotional creatures. When emotions come into play, sometimes it's very difficult to think and act rationally. So emotions can have significant threats to our financial goals. There are uncertainties that we encounter, risks that we encounter in our daily lives, and emotions can also get the best of us. So that being said, it is important for us to be able to identify those risks and understand how they impact our emotions. So let's identify some universal risks that can affect our financial goals. So, for example, like being injured or contracting a serious illness, something happened to our home or car, not being able to support a family member. So each of us have a different tolerance for risk and have a different perception of what we perceive to be risk. So how you handle these emotions and risk can influence your success in sticking to your financial plan that you created yourself. So take a moment, write down some factors that you consider to be of risk to your financial situation or to your family. So again, I'm going to pause for a moment, open up your workbooks to that page, and go ahead and write down some factors that you consider to be of risk to your financial situation or family. So next, we're going to talk about what ways to mitigate risk that we encounter. So when dealing with risk, you essentially have two options. So one option is to insure the risk, and the other option is to retain the risk. When you insure against a risk, such as a house fire, which you would buy homeowners insurance for, you're transferring the risk to a third party. You pay premiums to an insurance company, so you don't have to worry about the financial consequences of the risk you're insuring against. Insuring against a risk makes sense if it is a large risk. So insurance generally makes sense if it's a large risk. And the large risk of, for example, the house burning down, getting into a car accident where you're at fault and unfortunately have gotten into a lawsuit with the other party, or they're suing you for damages, a death in the family, or a disability. So anything that's catastrophic can be insured against, and that's where insurance really comes into play. The other option is retention. So you can retain certain types of risk. So that means that if that loss would happen, or that loss were to occur, you would be taking care of that loss. You would be paying for that loss. So retaining the risk is more practical for small risk, where the cost of insuring against it is just more than the cost of actually covering the loss. And this is where retention makes sense. And again, retention can depend from person to person, depending upon what do they have in their liquid savings, how much they've saved up in their savings account, and that emergency fund that we hear about. So it's important to have a good emergency fund so you can retain more smaller risk and don't have to go into debt to cover some of the costs from the unexpected losses. All right, so talking about how do you protect, so we talked about where you're at now, and when it comes to insurance against the risk, there's different types of insurances available. Obviously, we talked about homeowner insurance, car insurance. You have disability insurance, both short-term and long-term. You have life insurance. You have making sure the legal documents like wills, trusts, and your estate plan is in order. So there's different ways to look at how you're going to manage that risk. But what we've talked about right so far is where you're at now. We talked about emergencies that may come up, building that emergency fund, and then how do you manage risk around it. And then whatever your goals are, buying a home, different car, wherever you want to go. So we've talked about money, emotions, sort of putting a plan together to put that financial foundation. So again, this is all on the attendees, the people on this call, to take that ownership. And this is what I talk about, is that the first step is taking ownership, accepting where you're at, and creating those goals and prioritizing where you want to go. So after we've done that part of the process, we're going to start going into debt management and credit. What does that look like? So that's the next section of the presentation. So debt management. So we're going to talk about credit scores, credit card debt, good debt versus bad debt, budgeting basics. So we're going to cover that in this next section here. All right, let's talk about credit. So credit is defined as the ability to borrow someone else's money at a cost. So credit generally is not free. Credit helps families and communities to grow and build wealth. It is a very important aspect of our daily life because it impacts our opportunities and access to housing, car insurance, or purchasing a car, employment, right? So if you just go look for a job, they do a credit check. Utilities, medical services, buying a home. So credit has a significant impact in our lives. So it's important to understand how credit works and what it entails. So the amount of credit that's extended is determined by a credit score. And you've probably come across this if you've ever made any purchase where they had a credit check, or even upon employment. Credit scores are reported by 3 consumer reporting agencies. We have Equifax, Experian, and TransUnion. Each of them have their own formulas. The scores can vary depending upon the credit reporting agency. Some companies run reports with all 3. When you're applying for credit, some companies only pick 1 or 2 that they want to have the credit score from. But your credit score can be different from company to company. It's not the exact same formula. What I would encourage in order to protect your privacy and protect your credit is to go to each of those websites, Equifax, Experian, and TransUnion. You can request a free credit report on an annual basis. And we highly recommend that to take a look at what's on your credit report. We have come across situations where individuals sometimes have noticed that there's credit outstanding which they were not aware of. So it becomes important to take a look at that, and also to protect your credit score, protect your privacy and identity. It's free. It's available through all of these institutions. And one of the things I would recommend in your action items or the tail end of the workbook, just put down, obtain my free credit report from Equifax, Experian, and TransUnion. Now, unfortunately, you cannot see your credit score. You have to pay an extra fee for that. However, if you use credit cards and you have access to some of the credit card companies, when you go to the online portal, most credit card companies nowadays are offering free access to credit scores by one of these institutions, whoever they use, Equifax or TransUnion or Experian. So go online and take a look at if you have a credit card, take a look at your credit card company's website, because they may have a tool on their website where they offer free credit score. So again, establishing that where you're at today. So if improving your credit is a goal for you, is to establish that, hey, what's my credit score look like today? And that's the way to find out. So good credit scores obviously provide access to opportunities and services that we talked about in the previous slide. Good credit score, maintaining good credit score does lower your insurance rates as well when it comes to auto insurance. So it is important to maintain that good credit score. So it is absolutely important on how you use credit and you use it responsibly, because if you make poor credit choices, it will have an impact on the opportunities that you may have access to down the road. So we'll talk about what makes a good credit score. Okay, so credit scores are based upon these 5 factors. So the payment history, which is heavily weighted on, is all aspects of calculating credit score. So it takes into account the timeliness of the payments. If you're late in making payments, that's going to have a significant impact. The total amount that you owe to creditors in comparison to your available credit. So the total amount that you owe will also have an impact on your credit score. The length of that credit history as well. So the longer that you have credit history, so individuals that are just starting with credit history when they're 18 or just in their early 20s, they don't have enough history built up with the credit. So it becomes important to maintain that history with certain credit that you may have. So if you have a credit card that was maybe 10, 12 years ago that you've had for a long time, but you don't use it often, it would be important to keep that account open, because it establishes that length of credit history that you've had with that one bank or institution or credit card company. New credit, oops, I'm a little too fast. Let's go back. Okay, new credit. So new credit is every time you run a credit check, open an account, sometimes with employment, there's soft credit checks and hard credit checks. So soft credit checks is like employment, but hard credit checks are when you are applying for credit. You're applying for new credit card, you're applying for mortgage loan or auto loan. Those are hard hits on your credit score. And so every time you apply for a new credit, that impacts your credit score as well. And the types of credit used, a mix of credit with credit cards, retail accounts, installment loans, auto loans, mortgage loans. So the type of credit also impacts your credit score. So the form of credit that most of us are familiar with is credit cards. And the average credit card debt per home, per family, it is around just shy of $16,000. So let's just take a moment. I'm going to take another 30 seconds here, pause. And if you know what your credit score is, go ahead and write it down in your workbook. If you do not know, if you cannot answer that question, I encourage you to go home and I've given you some ideas on how pay the credit score. You can pay for one of these services, or you can go to your credit card company and they may be able to give you a credit score as well online. Most credit card companies offer that nowadays as well. So let's pause for 30 seconds and let you put in your credit score. All right. So we're going to talk about credit cards again. Now, credit cards get a bad reputation because a lot of people end up misusing them. We have to recognize that credit cards aren't necessarily bad. It's how we use credit cards can either be a positive or negative. So we'll talk about some of the positives and negatives. So the positives is the credit card, the use of credit cards can help you establish a good credit history. So as long as you make your payments on time, you pay off the balances, it establishes good credit history. It also allows you to protect against fraud because if you're using credit card, you get certain protections that if there was fraud or fraudulent charges, the credit card company waives those as long as you catch them in time. Versus using your bank account or your debit card where you actually hold cash. It allows you to hold reservations. So airlines, 90% of the time, I've yet to see airlines allowing the use of ACH via bank accounts, and most of the time seeing you need a credit card to make reservations at places. And even for emergencies, it's phenomenal. You're somewhere and it's easy to access that credit in case of emergencies. So if you have a medical emergency, you don't have enough money in your bank account, it's a way to access credit immediately. So if you don't have the funds available. And then bonuses. I mean, that's a big part of using credit cards because a lot of them have programs, so mileage programs, cash rebates, and different programs that are available. So if you're using it for those reasons and paying off your credit card balances on a monthly basis, those are phenomenal reasons to use credit cards. And you're using someone else's money or someone else's program to get free, let's say, travel points and get that free flight to go on a vacation. However, the negative use of a credit card is using the credit card when you really can't afford to pay the balance, when you already have debt, when you know that when you do not know your available credit, how much you have available, or we do not trust the person or device handling it. So there are lots of negatives around credit card, and that's why we see the average household is about just shy of $16,000 in average credit card debt. And something becomes very easy to use as well. I mean, so that ease of use is negative too, because we can just take out a plastic and swipe it. So, but let's go ahead and pause for a moment as well. So what is your estimated credit card debt and how many credit cards do you own? Again, if you cannot answer that question today, at this moment, encourage that when you do go home, you pull this information together because, again, part of that process is understanding where you're at today. So we'll pause for a moment. I know we had a few more individuals join in into the call. What I would suggest is if you have any questions as we go through this presentation, there's a question box. So go ahead and put your questions in there. If you did not receive the workbook that was emailed out yesterday, it is also in the handout section of the GoToWebinar app. So you'll just have to click the handout and download the workbook as well. All right, moving on. So we're going to talk about types of debt. So there's essentially two types of debt. Debt is created by using credit. Credit is not bad. Credit is good, but the debt is actually created by using the credit. And the number one reason people have debt is because they have no savings. So they got into debt, they used a credit card or got into another type of loan. It's because they did not have savings to pay off that credit that they received. So your savings, your emergency funds are your most valuable tool to avoid getting into debt, and your savings are important to also reduce debt that you may have accumulated. So essentially, there are two types of debt that you may get into. So one is a secured, the other one's unsecured. Credit cards are unsecured debt. There is when we talk about collateral. There's no collateral or against a credit card. A home loan, as an example, or an auto loan is a secured debt because there is an asset. There is something that is collateralizing that loan. So it becomes important on the type of loan that you pick up, and does that have any asset attached to it? When you're using debt, it is important to understand the terms and conditions of that debt. This includes the amount of the debt, what's the term of that loan look like, what's the repayment terms look like, and more importantly, the rates. The rates are absolutely critical because if you look at, especially for those unsecured credit card debts, that's what they charge you. There's nothing collateralizing that loan or that debt that credit that you've taken out, and because of that, they usually charge you a higher interest rate, and they can, on average, be anywhere from 15 to 20%. And if you don't have a great credit score, you could be paying as high as 22, even 25% on some of the credit cards. So it becomes absolutely critical to know these terms and the repayment terms for whenever you pick up debt, and what does that look like. So this is as of 2013, the total personal debt in this country has risen to about 2.7 trillion. Now, this is not including type of real estate or mortgage loans. So this tells us one thing about debt is like it's absolutely critical in terms of how we function in today's society. It's to purchase a home, to purchase an auto, to go to school. It's student loan debt. I mean, that's after mortgages, student loan debt is the second largest debt that exists. So you have to recognize that debt is a tool. And one of my mentors many times said, you know what, if I was to give a gun to a Marine, and I don't want to use guns as an example, but it's a great example. If I give a gun to a Marine or a police officer, I may feel very safe because they know how to use it. And versus if I was to give that same gun to my 5-year-old or a teenager, they may not know how to use that. Same thing with debt. Debt is a tool. And if you use it wisely and if you use it prudently, it's a phenomenal tool. However, if you don't know how to use it, you can dig yourself into a hole and really have a big impact on your cash flow. So the debt has to be you have to use the debt the right way, and you have to know yourself. So if you know that historically you haven't been able to manage debt well, then one strategy would be avoidance, is to avoid getting into debt. So use debit cards and your cash and your savings every time you make a purchase. So that really has to be managed. So again, we talk about proper and improper uses of debt. So proper use, similar to credit cards, the proper uses of debt. Just because you're able to incur debt does not necessarily mean that you should. In general, debt is used properly when it's used to purchase something you need and you can afford to make the scheduled payments on, such as taking out a mortgage and on a home in which you know the monthly payments are affordable and they fit within your budget. Conversely, if debt is used improperly, you may be purchasing items that you just cannot afford to make payments on. So it's important to realize that even if debt is used properly, sometimes circumstances out of your control can leave you with payments on debt that you cannot afford any longer. So an example could be unemployment or losing your job. So you should always have that buffer, that emergency fund, and that savings that we've talked about as well. So it becomes important to understand the proper uses and improper uses of debt as well. So, and we've talked the concept of affordability. We have talked about cash flow. So it becomes important to understand your budget. To determine your budget, you must follow you must know what you own and what you owe, what is coming in and what is going out. So that's what we'll talk about next is the personal budget. So the first step of creating a budget is to determine what you own versus what you owe. Com- and so basically comparing your assets to your liabilities. You do this to do this. You need to create a personal balance sheet. Now, a balance sheet is to help you determine your net worth, like what your assets are worth, what your net worth is, and what's the value of your assets minus your liabilities. So assets is everything that you own. So cash, investments, your home, automobiles, personal properties, any other assets, retirement accounts. Liabilities is what you owe: credit cards, student loans, mortgages, and any other personal loans that you may have outstanding. So there's a lot of tools available to online to generate your balance sheet. If you'd like a sheet, sort of a paper balance sheet, please do feel free to send me an email, and we'll be happy to provide that over to you as well. I'll go ahead and put it in the questions of the chat box. We'll go ahead and get you a sample paper balance sheet that you can use as well. The 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 key to having that balance sheet is to, again, know exactly where you're at today. What does that net worth look like? So the next step to building a budget is comparing your income and your expenses, what's coming in and what's going out. If your expenses are more than your income, then you're essentially living in debt. In order to be successful at budgeting, you must spend less and then you create the savings. When I say you have to create those savings, we have to take ownership of our cash flow. Someone once said to me, one of my mentors also said that it's not about how much you make, it's all about how much you keep. And budgeting and cash flow management can help you do that. So after you compare your monthly income and expenses, you have to set limits. You have to set limits and say, hey, you know what, this is what my budget will look like on how much I want to spend on groceries, on eating out. And we'll have to start making those small changes in our lives regarding and changes in our lives to help you budget better. So instead of eating lunch out every day, is perhaps bringing in a brown bag lunch at work. And that example may not apply given we're in COVID and a lot of us are working virtually, but making a conscious effort to save money and focusing on managing our expenses. And you also have to account for your financial goals that we just talked about before, right? What would take, how much money would take, and what would be the income needed to accomplish those financial goals? So keeping that in mind as well, and tracking your spending. Oops, a little too fast again. These are some personal budgeting tools that you can have access to. Some of them are free, some of them are paid versions. Again, these are in your workbook as well. I would say take a look at these. A lot of them actually synchronize with your credit cards, with your banks. Like Mint, I know is an example where they will automatically synchronize your credit cards and your bank accounts, and they'll pull data from those accounts. They'll automatically categorize it as to where your expenses are going. And also, it allows you to create a budget at the same time. So for example, if you say that you want to spend, just say $500 a month on groceries, well, it will automatically look at your data from your credit card purchases and your bank accounts, and it'll categorize the grocery purchases as groceries. And when you get close to that limit, it will also send you a email notification saying, hey, we noticed that it's 15th of the month, and you've already blown through 90% of your budget for the month of October. So now you have to make some decisions as to how you're going to strategically plan for groceries for the next 15 days. So I know Mint does that. I'm sure other tools do that as well. But here's a few examples. Leverage the technology. Some individuals prefer to do it on Excel. That's perfectly fine. Some individuals prefer to do it on paper. That's perfectly fine as well. But there is technology available that will allow you to make it easy on you in order to see where your money is going. So let's talk about takeaways. Let's talk about this debt and cash flow and budgeting. So I want you to consider the following items that we discussed. So it's important to create financial goals, understand how your emotions and daily lives impact those goals. We talked about credit, how it can be used positively or negatively. Using credit creates debt. So debt just doesn't happen, and credit is not bad, but using credit creates debt. Debt can be used properly or improperly, and having and adhering to a budget will help you achieve your financial goals. So this is the end of the presentation. So I'd like to pause for a moment. If you see if you have any questions, go ahead and put it in the question box. I'm gonna open up the question box here and see if any questions are popping up. So in closing this presentation, I just want to thank everyone for being on this call. We appreciate you joining us. And at the tail end of your workbook, to make this meaningful, and some of you may just listen to this presentation and not do anything. What I'm hoping is most of you open up the workbook. On the tail end of the workbook, there's an action items page. So create and write down those action items and hold yourself accountable. Put that in your calendar, in your to-do list, in your task list, whatever that is. Create these milestones. And if we at Strategic Wealth Design can be a resource, please do let us know. We'll connect you with one of our advisors, and they'll be able to guide you through some of these as well. So, but thank you for being here, and I'll just quickly check on questions and see if anything popped up in questions on the chat box. No questions so far, so I think I must have done a phenomenal job. All right, so given that there's no questions, I really appreciate everyone's time. Thank you. Have a great rest of your Thursday and an upcoming weekend as well. Remember, our next session is going to be next week, same time, same place, Thursday at 11 a.m. And if you have not registered, please do register. The topic is going to be we're going to be talking about investments and retirement accounts. So we're going to get into details about investing into retirement accounts. So if I do see we have several individuals that are participants in 401k plans that we manage, so it would be important to maybe join that session and learn about what does it take to invest in retirement accounts and 401ks, IRAs, and different vehicles as well. So we're going to get into retirement accounts next week, and then 2 weeks from now, we're going to be talking about retirement income planning. So for individuals that are close to retirement, that will be a good session to attend because that will talk about how do you plan for that retirement income as you get close to retirement. So with that said, thank you so much and have a great day.